was talking to an older gentleman about required minimum distributions. Now, this guy was investing mainly in CDs, so I want to walk through some of the common concerns that older people have and why putting all your money in your IRA and CDs could be a really bad idea. But typically what happens, people worry about the stock market as they get older. They think, wow, the market's so volatile, I kind of worry about putting my money there. I'm going to talk about the strategy that's used and how that would have worked over the past using real data over the last 25 years. Now, what's a required minimum distribution? Well, when you're putting money in your IRAs, your pre-tax IRAs, 401ks, or other retirement accounts, the way our tax system works is this. You have some income that you earn and you don't have to pay any taxes on it. Some of your income, the next income, is taxed at 10% as the tax law sits right now. Then it goes to 12%, 22%, and then 24%, and it goes up to 37% is the highest rate. Well, when you're putting money in these plans, you're avoiding that tax rate when you're working because you're saying, hey, I don't need the money today. Give it to me at some point in the future when I really need it and I'm not working anymore. Well, what does that day look like? That day looks like you're taking some of your income down at these levels. So you can avoid these levels and take the income at those levels when you're dealing with traditional IRAs. And that's the idea behind it. So that's what we're looking for, is the differential between your marginal rate versus your average rate. So he was looking at this and going, well, I put all my money in CDs. And I said, well, let's talk a little bit about that. What are RMDs? Why are they necessary? The reason they're necessary is because the government has to get their money from your account at some point in the future because they've never gotten any tax money on your income. How are they calculated is the next question. Well, when we're talking about how you calculate it, they take your age. Now, 70 and a half was what it was forever. Now it's 73 for anybody born prior to the 1960s. And 75 if you're born 1960 or later. That's the age you have to start taking required distributions. The way it works is this. Let's say it's 73 for the sake of this video. Let's say that's when you have to take your required distribution. They actually imagine that you are married to somebody age 63, 10 years younger than you. And they take your joint life expectancy and they say, well, what would be the joint life expectancy of somebody 73 married to somebody 63? Now, if you're married to somebody more than 10 years younger, you can use an alternate table, but I'm going to use this for now, right here. Even if you're single, this is what they do. So you may be a 73-year-old, not married at all. They still look at this joint life expectancy. And then what happens is they take your account value as of the end of the year, prior to the year that you have to take the distribution. So let's say you have to take that distribution in 2025. They'll take your account value as of December 31, 2024, divided by that joint life expectancy. So let's say it's 25 years to keep the math simple. You've got $100,000, you divide it by 25. That means that you've got to take out $4,000 or 4% of the account value. So that's how this works. Now, each year as you get older, your joint life expectancy goes down. So then the percentage goes up, and you'll see that in just a second. So that's the idea. Look at that value and then take it based on that factor. Now, if we have $3 million in IRAs, congratulations. Let's say you have an IRA worth $1 million, then you got another IRA worth $2 million. Your joint account value is $3 million. Then what happens, they take the joint life expectancy, in this case, for somebody that is 74 years old, married to a 64-year-old, it's 25.5. So you divide that account value by that, that's $117,647.06. That's your distribution that you must take. Okay, so that's how it works. And as I said, percentage goes up each year. Let's say that we use what's called a GIPS audited 60/40 portfolio. So we actually audit client returns. We have our returns audited, what the returns are after all expenses. And this is diversified between large companies, small companies, large value, small value, international large, international small, international large value, international small value, emerging markets value, emerging markets, a lot of different asset classes, right? All around the world. And then you have 40% of your portfolio in bonds. Well, why does that work really well? The studies show that it works really well because I have enough money in bonds that no matter if the stock market's down, let's say that markets are down in general, bonds typically hold their value when markets go down, and I can draw income from the bonds to buy me time for when stocks come back, because stocks always come back. They have always come back because they're companies run by people that better make sure that the stock comes back or they're fired. So that's the idea. And if stocks never came back, that means earnings never came back. If earnings never come back, then taxes go away. If taxes go away, the government goes away. So I never worry about stock markets not recovering. I want you to get that idea. So if I'm diversified, 60% stocks, 40% bonds, I have enough in fixed income bonds that I can wait for stocks to come back. I want you to get that point. Now, these are using actual returns from the year 2000. I use that because that was an awful period of time. Those of you that lived through it, tech stock bubble burst, stock markets going down all around the world. What happens when I take an income from $1 million portfolio? Well, my income is just shy of $40,000 first year, right? Because as we established, it's about a 4% distribution rate, somewhere in that neighborhood, right? Then next year, what happens is my account value does whatever it does, and I take the distribution based on the joint life expectancy of a person a year older, married to a person 10 years younger, voila. Let's say it's about 4%. Now, here's the beauty of the RMD. I can't run out of money. If I'm always taking a percentage of what's there, I can't run out of money with a required minimum distribution because I'm always taking a percentage of whatever is in the account. Hope that makes sense. Now, with a 60-40 portfolio, you have fluctuation in value. But what I want you to notice is each year, that yellow bar represents my distribution. The black line represents, if I started at this income level right here, what would I need to keep pace with inflation if I'm taking income out and I need to keep pace with inflation? You notice something interesting here is that most of these bars are above the black line, meaning that I got more income than I needed to keep pace with inflation with a 60% stock, 40% bond portfolio, all the way out to here. Now, how old would I be out there? I'd be in my late 90s by the time we got there, because I'm imagining starting the year 2000, and I'm 73 in the year 2000, and I'm imagining taking the income out every year. So you notice something, my 60-40 mix did a really good job of giving me the income and the required minimum distributions that I needed throughout retirement. Now, these are the actual numbers. And what I want you to notice is that don't get bogged down in the individual details. I just want you to notice that we started with $1 million portfolio. And what I did is I took my distribution just shy of 4% right there. And then I just took a percentage of the portfolio every year based on the ending year account value. Now, the first year, this is a really good example. Remember I said the stock market went down. But because we are so diversified, it didn't go down much compared to what a lot of investors actually faced in the early years of the tech bubble bursting. So what happened is I have a smaller account value at the end of the year. Now I'm going to take a percentage of that, which is close to 4%. Remember, the percentage goes up a little bit each year. So that's what why don't you remember. Now, as time goes on, what happens is my distribution grows from $37,000, and finally now in the most recent year, it's $78,000. And remember, that was more than I needed to keep pace with inflation. Do I have any, now what percentage of my portfolio am I taking that year? I'm actually taking about 13% of the portfolio, because remember, now I've got like a 96-year-old married to an 86-year-old, and the life expectancy is significantly shorter, so the percentage I have to take out is much higher, is what we're seeing there, right? So it shouldn't surprise me to see the account value has gone down some in value, but not as much as you might think. We're still sitting on almost $600,000 after all of that time, and literally $1.5 million of income coming out over that period of time. Now, what if I use CDs to do this little trick, and I took the same amount of income? Now, I'm going to ignore the RMD rules here for a second. I'm going to take the same income that I would have taken from this 60-40 portfolio. Same exact income each year. $37,000 growing to $78,000. And what I want you to notice is that 4 years ago, I ran out of money. Literally, my account balance is negative almost $300,000 in the hole after that period of time trying to take the same income out. Why? CDs were never designed to protect us from inflation. That is why I tell people this is not something I would try when taking your IRA and putting it in something like that. To take that a step further, let's look again. This is my 60-40 portfolio, and here's my over 1.5 million in income, right? Started with 37,000, grew to 78,000. Now, let's go back to using the CD, the RMD rules applied to CDs. Because remember, I said you can't run out of money. So I'm going to take the account value and I'm going to raise it by whatever the interest rate was, and then I'm going to take a distribution based on those life expectancy factors that I talked about earlier. My first year, what's my income for my CDs? It's the same, right? 37,000, about 38,000. Now, next year, I'm taking out income, and my income is going to be based on whatever the account value is at the end of the year. What's my ending income last year? Interestingly, if you note this and look at this, it says my income was only 36,000. What happened? I didn't keep pace with inflation. I started out with 37,000 of income, and here I am literally 25 years later, and I've got less income coming out. Well, what happened over that period of time? The price of stuff went up significantly, and I didn't keep pace with inflation. I actually went backwards. And what's my ending account value? Actually, only 262,000 versus about just shy of 600,000. So not only did I not keep up with income, I ended up with a much lower account value, and I ended up getting hit on the inflation front. So when we look at this, we go, wow, there's a lot more to meet the eye. We talk about diversification. It is so important. And when we look at equities, stocks, we hold stocks. Why? Because they have historically protected us from inflation. Why? Because what is inflation? Prices going up. Who's raising prices? Companies. What do you own when you own stocks? The entities raising prices. Diversification, critical. Doing this right is critical. There are rules to investing we want to follow, and there are some really good guidelines on how to take income from an investment portfolio, and you can see now how and why it works.